Well, good morning, everyone. Welcome to today's marketing webinar for June 23rd, 2026. Just a reminder, our next webinar will be July 14th at the same time. And just a reminder, our Riskology series, we have started that series third Tuesday of every month. Anyone that's new to risk management or wants to know more about this kind of space, I would recommend you to check out our YouTube channel as we post beginner videos there. And now Rob will take over the hog portion of the webinar today.
Good morning, guys. Not a whole lot of excitement again in the hog market. We struggled to move any higher here and just kind of remain in that downward trend. But this is a look at the April hog futures there, and as you can see, they're just kind of holding that support level near that $82 back from their December 2025 lows, and so far haven't really moved much past that, and kind of seems to be on a bottom side here. Next, we'll go over and look at the hog harvest. Last week's estimate slaughter was 2371. This was up about 1% from last year, 2342. But if you kind of look at the last 8 weeks, we're really very, very little difference between the past 8 weeks year over year. Kind of killing the same kind of quantity of hogs there year over year. So just not a significant change. If you kind of look back at that last hog and pig report, it would have said kind of a similar story, where we're looking at very similar numbers to a year ago. So getting kind of the same slaughter that we've seen. Hog weight side, though, we are up and remain high, but we have fallen off in kind of that seasonal tendency for this time of the year, but remain a couple pounds above last year at this time. Weights still remain pretty good. Weather-wise, just haven't seen a tremendous amount of heat so far yet, so keeping that weight on there. Looking at pork production, though, with that added weight and kind of similar numbers to last year as far as hog slaughter, that puts our production at 517.6 million pounds last week. Comparing that to last year, 508.5 at this time of the year. That's about 1.7% greater than what we seen last year with the additional weights being on there. So lots of pork still in the marketplace today. Moving into the cash isoine price, 52.29, down 434 on the week there. Finally kind of got past that 2025 line there, seeing kind of that seasonal downward spiral, but still elevated price compared to where futures are at this time of the year, and how that break even would look with that kind of pig on feed. Looking at the pork carcass cutout there, down 62 cents last week, but 96.08 was kind of where that was at, and that's about $22 lower than last year. Still, you just look at that, and that line just kind of remains in that range that we have seen. Hasn't really surpassed that much, but just kind of flat line there. You can kind of see the same thing if you would look at the beef cutout as well, where it just seems to be kind of in this pattern of moving sideways a little bit. Last week we saw the overall cutout down 62 cents. A lot of the lower came from the butts and the picnics there, as well as the ham and the trim. But get a little bit of strength, on the rib. It's that kind of time of the year where we got 4th of July coming up here, and some folks are out getting their needs for that 4th of July holiday, and the belly is seeing some strength too in the seasonal kind of time frame. Bellies will probably have a little bit more strength as we move into that BLT season here coming up. This is just kind of a chart on the belly side of things. They were the biggest improver last week at up 521 for the week. Still nothing real exciting, but as you can see, from that seasonal time period, we get a tremendous amount of strength coming up here. So it'll be something that we will definitely want to keep an eye on, watching, see what that belly can do. Overall, in the retail side of things, it doesn't seem like there's a great abundance of demand quite yet, but very hopeful that we'll see, some retail demand pick up there. The hams have been a bit disappointing as of late. This is both a factor of, I would say, domestic use, looking at deli meat kind of side of things, and also our global use. Mexico has been down a little bit as of late as far as their exports as well. So just not seeing a tremendous amount of demand here in the ham side of things um, as we look forward here. Um, Exports, though, last week, net sales of 16,100 metric ton. That's a marketing year low. That was down 31% from the previous week. Export shipments were down 12% from the previous week. And as you look at that, you can see that our trend has been a little bit down on that net sales side of things. We started fairly high and we're kind of working our way a little bit lower, but hopefully we'll see some pace improvement coming up here. And just kind of looking at year to date, we're sitting pretty good. 20% above, where we were last year looking at these weekly exports. And these would be shipments, but pretty much all of our big partners, Mexico, Japan, seeing some good strong pace above last year and above the 5-year kind of averages there. So really overall, so far this year, we're sitting pretty good. Just the last couple of weeks, it seems that it's been a little bit of a slower kind of sales taking place there. The next one's looking at Japan and Mexico from a weekly standpoint. And you can see, Mexico kind of dropped off there compared to where we were last year. Japan kind of dropped off compared to what the sales were like last year as well. So just kind of seeing a less exciting week there last week. Looking into Mexico a little bit, they are currently negotiating this USMCA agreement. I don't know that it was the best thing to find on the internet last week, but Trump basically mentioned he would rather not have an agreement, but he may sign it. I'm not sure really what is technically going on with this agreement, but having a comment like that probably isn't very helpful or showing a positive tone at least. Looking at managed money trade there, lean hogs, I took off another 7,258 contracts there. Sitting with a position of 20,959 contracts, kind of near that record short for the lean hog complex. So money's still not in the market and they are getting near that record short. On the dollar side of things, today the markets are pricing about a 70% chance that we're going to see a rate cut. That's increased our strength in the dollar quite a bit, trading in that $100 and higher range. Significant strength really in that dollar. Comparing that dollar to our competing proteins month over month, most trading partners, you can see that the dollar strength has been not an advantageous to our exports, hurting our exports a little bit there. But Mexico has had some strength in that peso, keeping that pretty much unchanged. Looking at the year over year changes as well, Mexico's peso still has had that strength, making it 9.6 advantage of the peso to the dollar year over year. But you're seeing that in the Japanese yen, the euro, and the Canadian dollar, etc., that that dollar strength has been harmful for our exports. This is just kind of looking at Mexico hog prices over there, but this year they're at about 96.40 on a dollar basis. Last year at this time they were at about 111.45, so about $15 less this year than last year at this time. But 2 years ago, you can see that right about this time of the year is kind of when that Mexico market took off. We jumped up about $34 there in 2024. So it'll be interesting to watch to see if they get some of that seasonal bounce here going forward. But for now, hog prices over there are quite cheap. The next thing is just kind of looking at our hog margin, generic hog margin model. And while A lot of things aren't really, in our historic target area. We're offering about 12.43 is what we're offered today, margin today per pig, with a historical target of about $15 there. A lot of that weakness really is seen, in that fourth quarter to first quarter of 2027, where we're just not seeing a tremendous strength in those deferred markets as of late. But the decrease in some of those input costs has kept this thing fairly close to even, a historical target kind of time frame.
So now we'll jump into the grain side of things. So starting with crop conditions here, overall, I can't really complain. So right now we're about 68% good to excellent on corn. That's above the 5-year average of 65%. So, continue to see good conditions there along with, favorable weather basically across the corn belt. I mean, maybe you got a little problem spot out west for dryness in Nebraska and South Dakota, but overall pretty good. Soybeans, 66% good to excellent, and that's above the 5-year average of 63. So overall, the crop's off to a great start. So looking at the corn balance sheet here, so we will have a WASDE report middle of July there, but just that right-hand column there, just to remind, just kind of what we're looking at for next year. So we're looking at about a 184 yield, and the crop conditions, the way they've started, maybe we could see a bushel jump in July, but normally they kind of wait till August to make any change like that. But I think it's just important to remember that with the great demand we've had over the last few years, they're plugging in a lower export number for next year. So even if they were to raise yield, you could probably argue that this export number in corn is probably due to increase. And also if you get China involved in the corn market as well, you could see, a better export number there. Exports sales for the old crop month has been really good. So 6% ahead of pace needed for the USDA forecast, up 26% versus a year ago. So for last week, the sales were about 45.6 million bushels. And you can see on the bottom there where those sales were too. So are seeing some sales for new crops. So that's good to see. And like Rob was talking earlier on the USMCA deal, it's good to see Mexico still buying corn despite all that going on there. Ethanol margins continue to be great. I have taken a dip over the last week there. Ethanol lost about 12 cents a gallon last week, and distillers grain lost about 12.50 a ton. But versus last year and versus the 3-year average, we're still seeing great margins there. So ethanol and end users are definitely incentivized to keep that pace going. And if you look at ethanol corn grind, the pace needed to reach the USDA forecast, we're running right at that 5.575 billion USDA forecast. So the USDA did revise that in the last WASDE report down 25 million bushels, but it looks like we're following pace there to hit that target level. And looking at the soybeans quickly, like I said earlier, crop conditions continue to look good. So even if you were to raise yield half a bushel there, it increases our carryout to about 350 million bushels of ending stocks there. So it'll be interesting to see. The number we're kind of watching is that export and crush number. Definitely seeing, with margins being great for the end users and the crushers, continue to see that increase here. So they're thinking about 2.75 billion bushels for next year, and that's pretty close to full capacity. But exports is going to be the really interesting number to watch. Are we going to get China into the market next year? And we did see them poke around for some bushels last week. So it'll be interesting to see if they can actually purchase that 25 million metric tons like they have said. And looking at soybean export sales progress over for the last marketing year, continue to kind of fall behind pace there. So the USDA has been able to keep revising that down and kind of offsetting that with crush. But the thing to note there is the weekly soybean export sales destinations last week. And you can see there the new crop sales. Our biggest sales there was the unknown destinations. A lot of speculation that is China. So it'll be interesting to see what kind of pace they have over the next few months here to see if they can actually be on target for that 25 million metric tons. Soybean crush. So soybeans were, have kind of fallen off here, and soybean oil has too as well, along with meal, kind of seeing both of them unwind back in price. But nonetheless, margins continue to be great. Last week, 442 a bushel. That's up 240% last year. So that chart definitely stands out to me. Soybean meal exports currently on a record pace with 12.4 million metric tons shipped through June 11th. So the USDA is projecting a 9.5% increase in exports versus last year, and we're currently 17% higher than last year. So still seeing great demand for meal as countries, including ourselves, include more meal in their hog diets and such. But you can see there as well, Mexico continues to have great demand for corn and soybean meal as well. I'm looking at weather quickly. Really nothing too worrisome about this. There is some drought creeping into Iowa, more into western Minnesota here, but I would say the so-called problem areas, the drought areas, would be kind of close to home here: southwest Minnesota, eastern South Dakota, eastern Nebraska, and central Iowa as well. But over the last 5 days or so, have seen a lot of rainfall. The I-states keep getting a lot of rain, and along with Nebraska and Kansas as well, as they've caught a few shots as well. And looking over the next week or so, a lot of the Corn Belt will be covered with rain. It looks like Iowa might miss out on some, which will be something to watch because we are going to receive some hotter weather here, hotter temps at the beginning of July. So it'll be interesting to see if the market really cares about Iowa not getting rain while getting hot temperatures. And just an update on Iran. Sounds like Trump signed some sort of a deal, but despite a lot of confusion with a lot of the headlines that we've been seeing, the futures market is taking that the war is basically over. As you can see there on the crude oil chart on the bottom, we're trading about $75 up front, probably lower today, around 72. We're almost to pre-war levels. So despite oil reserves being at our lowest levels ever since 1983. The crude oil market's still trading below that $70 level, but nonetheless, it seems like the futures market's kind of getting sick of these headlines and kind of more phasing them out from when the war first started. Did have a little bit of China news last week that helped propped up this grain market for a couple of days. So did see some flash sales there for new crop. So they're about 0.528% of that 25 million metric tons for the new crop marketing year. But wish we could have seen maybe more of a rally in the soybean market and the corn market. But I would think going forward, if we continue to see more purchasing from China and more continued demand week over week, that might offer some support on the soybean market going forward with a pretty tight balance sheet already. Money flow, I mean, just looking at managed money, it's been pretty important for grain price movement over the last few weeks here. So managed money on corn sitting around 46,000 short. And just recently in the beginning of May, we were almost a record long there, 350,000. So shed a lot of longs there over the last month. The managed money was into that market probably because of inflation buying, maybe a fertilizer story, China possibly buying U.S. corn, but none of those things have really came to fruition. And you throw that on top of good weather, they've really shed their long length there pretty quickly. Soybeans still hold a decent long position there, around 52,000. So still have room, I would argue, to the downside if the funds want to liquidate more on that contract. But looking at funds last year, this is corn. So that first blue line on the left there is beginning of February, and that's kind of when we made our high in the corn market. So seeing a similar pattern to this year, they took about 5 months to go from 350,000 long to, first week of July to go about 200,000 short. And we're kind of seeing the same formation here. So 350,000 long beginning of May, and then we're about 50,000 short now. So it'll be interesting to see if the managed money will want to really go short this market with good weather and more ample supplies, it looks like this year for the U.S. production. And just looking at seasonals, seasonals are really not in the row crop guys' favor. So from now on, after Father's Day, you tend to go down over the last 30 years. So don't really have seasonals in the corn market's favor or the funds. So it'll be interesting to see if we can do anything counter seasonal or not. Seems like we went down pretty fast and early in the marketing year, so maybe we can make some early kind of low, but normally the seasonal trend is just to go down to the end of August. And that's all kind of me and Rob had for you guys today. Let us know if you have any questions, and just a reminder, next webinar will be Tuesday, July 14th at 9 a.m.